Hello everyone. Thanks for joining me today for this presentation. Before we dive into our presentation, let's warm up with a little tax brain teaser about Bill. Sounds like fun, right? Let's get started. So after working hard for his adult life, Bill, 65, has finally retired and he's going to more concerts than ever before. Bill has $48,538 in taxable income, which includes $37,500 of Social Security benefits this year. As you can see, Bill's $48,538 of taxable income puts him in the 22% tax bracket because it's more than $48,476 and less than $103,350. Toward the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to see Willie Nelson play in Austin. How much is he taxed on that extra $1,000? The logical answer is that for every dollar of IRA money he pulls out, he pays 22 cents in federal income taxes. Therefore, if he took out $1,000, he should owe $220 in federal income tax. 22% tax. Simple enough, right? He owes $407 in tax, a 40.7% federal tax rate on that income. Thanks to the madness that is our tax code and the unique formula that determines how your Social Security benefits are taxed, the real answer is that Bill owes $407 on that extra income. Welcome to our presentation, How Tax Planning Changes Through 4 Stages of Retirement. My name is Joseph Budd, and I'm a certified financial planner and managing director with Budd Wealth Management. We have developed and refined our client life process over the last 20 years to work with families that aspire to a work-optional lifestyle. We hope to put all the pieces of the financial puzzle together for our clients. Connect with us on LinkedIn and Facebook, where we post interesting personal finance content on a regular basis. I thank you for coming out to learn more about taxes in retirement. And I want to assure you one of the things about this presentation, I believe you'll be better informed about the challenges of retirement tax planning after listening to this talk. Now you may be wondering, why is a financial professional giving a presentation about retirement tax planning? From time to time, I present workshops, classes on various financial education topics such as Social Security, retirement planning, IRA planning, healthcare planning, cybersecurity, and late-stage college planning, among others. My goal is to always inform and educate my audience so that you can understand how critical financial planning topics affect you and your family. I do this presentation because I've seen many people make mistakes and pay more taxes in retirement than is necessary. When that happens, it makes my job harder because people have less income in retirement and we have to find ways to make their portfolios last. Taxes can seem complex and jargon-filled, and even though the underlying concepts are fairly straightforward. So let me take a second to explain how this workshop will unfold. This presentation is organized in 4 keys. Each key builds on the previous one to form a solution to our presentation problem, as you'll see. I want to mention that at the end of our presentation, I'll invite you to a follow-up session about taxes in retirement. It's a complimentary one-on-one consultation that's available to you in exchange for you spending some time with me today on this presentation. I'll tell you more about that later. I also want to assure you that this is not a sales presentation. You'll hear nothing remotely close to a sales pitch, but you can see what we're going to cover on the agenda that's on the next slide. But now there's one other important point I need to make. Everyone's tax situation is different. You should always consult a qualified professional tax advisor to discuss your specific tax situation, especially about these topics. Traditional IRAs, tax deferred, you must pay taxes on distributions or conversions at ordinary federal and state rates. Roth IRA, non-deductible, money grows tax-free, and earnings will be withdrawn tax-free in accordance with the IRS rules. This presentation references only federal taxes. Check with your tax professional. I am a financial advisor and I do not provide tax advice. What I do is help people understand how the tax code and other rules could impact their financial planning and investments, and then we develop a plan to take into account many of the odd things people encounter, especially around taxes in retirement. Our goal here is to help you understand that the retirement distribution game, spending assets in retirement, is much different than the accumulation game when you're saving for retirement. Chances are you have been in the accumulation phase of your life for several decades and you've been working hard and trying to save money, and hopefully your accounts have grown. But now, as you enter or prepare for retirement, you're in an entirely different phase, the distribution phase. And the distribution phase has new strange rules that can catch people off guard, and along with those new rules, there are often many changes in your own personal life that can have a big impact on your taxes too. For instance, your children are grown, and that means no more child tax credits. Your house may be fully paid off, and that means no more mortgage interest deduction. If you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you've stopped working, you may no longer have the ability to stash income in a 401k or similar plan to manage your annual tax bill. At some point, you'll start taking Social Security, and sooner or later, when you reach 73, you'll have to start taking required distributions from your retirement accounts. The list of changes goes on. Many aspects of retirement will affect your tax bill in ways totally different from your working years. Understanding what these are and how they can impact you is absolutely crucial. There are some resources that will be available in a follow-up email link on our website, and they summarize everything we're going to cover today. So I want you to enjoy the presentation and not feel like you have to write every single point down that we cover today. This session is also being recorded, and you'll receive a link to that in a follow-up email. You have to know what your after-tax retirement savings picture looks like before you can actually retire. That's our first key number one. Because a $500,000 401k or IRA balance isn't really $500,000. The government has a claim on part of that money because the taxes were deferred. They'll get their share when you're forced to start your required minimum distributions. The Secure Act 2.0 has pushed back RMDs to 73 if you were born between 1951 and 1959. And if you were born after that, you won't have to start taking RMDs until you turn 75. Obviously, the higher your tax rate in retirement, the less your account is actually worth. Here's an example. This chart shows you the cumulative after-tax value of a $500,000 IRA earning 6% a year at various tax rates. And as you can see, the lower your tax rate, the more you keep. Simple theory, difficult in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees, so don't worry if you've already started your retirement. Tax planning is important throughout your retirement. And the disclosure on this slide, note the illustration is hypothetical and assumes 6% rate of return. This does not represent the performance of any investment product, and your results may vary. Ordinary income tax rates will apply to withdrawals from a tax-deferred investment. An investor should consider his or her current and anticipated investment horizon and income tax bracket when making an investment decision. Social Security and Medicare have their own tax traps that you need to plan for as well. Let's go back to Bill from our tax brain tease. We want to understand why he paid such a high tax rate on the extra money he took out from an IRA for a road trip concert to see Willie Nelson. Remember, Bill has $40,000 of IRA income, part of his adjusted gross income of $65,538, and he has $37,500 of Social Security benefits. That puts him squarely in the 22% bracket, and he takes the standard deduction. Yet, when he took out the extra $1,000, he got hit with nearly a 41% marginal tax rate, $407 on the $1,000. Let's break down how this actually happens. First, let's remember the only difference between our two scenarios here is that Bill has taken an additional $1,000 from an IRA. You see in the after concert trip column, he has $41,000 in IRA income. So we see here that by adding the $1,000 additional income, it increased both his adjusted gross income and his taxable income by $1,850. That means for every dollar of income he actually received, he's being taxed $1.85. How can that be? Here's the deal. Depending upon how much other income you have, the amount of your Social Security benefits that are taxable varies. For instance, if your other income is low enough, all your Social Security benefits will be income tax-free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. Bill finds himself in the latter scenario. At his current income after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must also add an additional 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% rate for every dollar of additional IRA income he actually receives. And if you do the math on that, it comes out to 40.7% real tax rate on the additional $1,000 of income. 40.7%. That's the so-called Social Security tax torpedo. It can impact single filers and married couples with even fairly modest income during any stage of retirement. It's one reason planning taxes in retirement is important. Now let's take a look at how Medicare has something it calls IRMAA, and it can impact some couples in the go-go years and beyond. First, what is IRMAA? It stands for Income Related Monthly Adjustment Amount. The emphasis is on income because it is a monthly tiered surcharge, again, a kind of tax that is tacked on to people's Medicare Parts B and D premiums. But it only happens if you have income over $106,000 for single filers and $212,000 for married couples filing a joint return. Let's take a look at what this means in action. Meet George and Martha. They are a high-earning married couple, and both are Medicare Part B and D participants. IRMAA surcharges affect income from 2 years prior, and this couple was on track for $334,000 of modified adjusted gross income, or MAGI, in 2023. But on December 1st of 2023, George decided to sell a stock he bought for $10,000 on July 1st, 2007, and he sold the stock for $11,000. The resulting $1,000 of gain was taxed at the 15% long-term capital gains rate plus an additional 3.8% net investment surtax for a total tax bill of 18.8%. That 3.8% net investment income surtax is another tax that comes into play when your MAGI exceeds $200,000 for singles and $250,000 for married couples. So George and Martha owe $188 of tax on the gain from the sale of stock, 18.8% of $1,000. Or do they? Remember, my definition of a tax is any cost that increases as your income increases. So then, George and Martha will owe more tax than the $188 because the gain from the sale of stock pushed them off the Medicare IRMA cliff into paying higher Medicare premiums. Let's take a look on how that works. Look at this Part B IRMA chart. That extra $1,000 gain pushed their AGI into the next premium tier that starts with $334,001. So now instead of owing $370 each for their Medicare Part B premiums, George and Martha will owe $480.90 per month, an extra $110,000.90 a month times 221.80 for an annual total of additional income-related monthly adjusted Medicare Part B premiums of $2,661.60. But it's not over, because Medicare Part D IRMA charges are also impacted. George and Martha will each pay another $21.70 a month on their drug plans, an extra $520.80 for the couple over the course of the year. Adding all the IRMA surcharges together for the year, George and Martha will each owe an extra $132.60 a month, or more than $3,000 of combined additional charges for the year. Now combine that with the $188 of actual federal income tax they would owe on their stock sale, and the total tax owed on the $1,000 of gain comes to $3,370.40. That's a tax rate of 337%. Let me repeat that. That's a tax rate of 337%. Let's do a quick review. They sold the stock for a $1,000 income gain. The sale of the stock sale tax was $188, 15% for long-term cap gains plus 3.8% for the net investment income tax for high earners for a 18.8% rate. The extra income from the stock triggers the new IRMA tiers. The total IRMA surcharges amounts for the year to $3,182.40 for George and Martha. So the extra $1,000 income triggers taxes of $3,370.40. 337% real tax rate. You see, being pushed into a higher Medicare Part B and D premium range is worse than being pushed into a higher tax bracket. That's because if you go over a regular tax bracket by even a dollar, only those last dollars are taxed at the higher rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move into the next premium tier. It doesn't matter if you exceed the limit by $1 or $10,000. That's what they call the IRMA cliff. Keep in mind, your IRMA payments aren't determined by how much money you made the previous year, but rather your modified adjusted gross income from 2 years ago. It's another tax thing that catches people by surprise and needs planning. Making sure that you enroll in Medicare at the right time is a critical decision. And if you bungle it, you'll get hit by a lifelong penalty. To help you understand, meet Jim and Ann, both 68. Jim retired at 65 and Ann retired at 66. Prior to her retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because her employer offers retirement health benefits. Which brings us to example number 3, enroll in Medicare Part B as soon as they retire. Unfortunately, they didn't know they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize the mistake until it was too late. And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until the next year. In a worst-case scenario, this might have resulted in a gap in coverage for Jim and Ann if they had a major medical need. But even in the best-case scenario, because Jim and Ann missed their deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B base premium penalty for life. You can see how much this translates into real dollars. They owe $444 extra in 2025. And historically, we can estimate that premiums will be higher or so. So the 10% penalty will grow, and over the course of a lifetime, this could translate into a $10,000 mistake for this couple. For simplicity's sake, we're assuming that Ann's retiree health insurance covers prescription drugs, so they won't have to sign up for Part D. But just know there's a penalty for that too. We've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So if you're like some who've seen this presentation, you might be asking yourself, wow, are there other tax traps we will face in retirement? Well, the rest of what we'll cover isn't like what we've seen with Social Security Tax Torpedo or the Medicare Irma Cliff. The public generally isn't aware of those tax squeezes. But what we are going to see now is how the tax code in plain view snags retirees, especially when there's no planning. And that brings us up to our third key. Key 3, you must plan how and when you will use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. You must plan how and when you will use these resources. You can't be haphazard about tapping your tax-deferred savings. Timing is everything, and if you don't plan carefully, through all stages of retirement, you'll encounter unintended tax consequences. Let's take a look first, addressing a question I hear often when doing retirement planning: which accounts to spend first? One way to help manage your retirement income before and during retirement is to utilize Roth IRA conversions. A Roth IRA conversion is a simple process that allows you to move money from an IRA or other pre-tax retirement account like a 401k to a Roth IRA. In general, the amount that you convert is added to your income for the year and will be taxed at your rate. For example, if Jill converts $100,000 from her IRA to a Roth IRA, she will have to add $100,000 to her income. The conversion income will be taxed at Jill's rate. For that reason, it's recommended that prior to making any conversion, you consult with your tax professional. A conversion doesn't need to be an all or nothing, though. One helpful conversion approach is called filling up the bracket. Often, you will find yourself in the middle of one of the tax brackets with room to add more income without pushing yourself into a higher bracket. For example, in 2025, the 22% tax bracket for married couples filing a joint return goes from about $96,950 to about $206,700. If you file a joint return and your taxable income is $110,000, that means that you could add another $95,000 of income without going into the next bracket. Making a Roth conversion like that could make sense. If you plan to convert a large IRA, this approach is often more tax efficient than covering the full amount in 1 year. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on your converted money and also spreads the tax bill out over a longer period. Some tactics you could use in managing income around tax brackets might include withdrawing tax-free money from life insurance policies to keep income low, selling highly appreciated stock for low or no capital gains, taking distributions from IRAs or 401ks to take advantage of a lower tax bracket. And as we've seen, you can also consider partial Roth conversions to fill up lower tax brackets. There is also 2 other pre-retirement strategies to consider, but they don't apply to all people. First has to do with using a health savings account. This would only apply to people who are covered by a high deductible health plan. The second has to do with small business owners. Those who want to be extra tax savvy in saving for retirement can fund a company pension plan, which for certain high-earning business owners can increase their ability to claim the Qualified Business Income QBI deduction. Both those features of the tax code could be used to manage your tax exposure and provide significant tax-favored benefits throughout retirement. If either or both of those apply to you, go ahead and make a note now for maybe down the road to consult on that item. We've seen throughout our presentation the critical importance of managing our tax-deferred accounts because at some point you'll be forced to take out required minimum distributions or RMDs, and that can be troublesome to your tax bill. But many people make charitable donations supporting their favorite nonprofit with annual gifts. So let's look at how your RMDs and charitable giving may work for you with some planning. Meet Albert and Shirley, who are in the 24% tax bracket. Now the standard deduction for a married couple filing a joint return for 2025 is $30,000. But Albert and Shirley are over 65, so they each get an additional standard deduction, bringing their total standard deduction for 2025 to roughly $33,200. This means they will receive no tax benefit for any itemized deduction unless their total exceeds the $33,200 mark. So if Albert and Shirley have $15,000 of existing itemized deductions, say from state and local taxes, deductible medical expenses and mortgage interest, what happens tax-wise if they donate $5,000 to charity? They get no federal income tax benefit for making the charitable contribution because it doesn't exceed their $33,200 standard deduction. That's not to say they shouldn't do it, but they should understand it's not helping them save on taxes. Now if you're over 70 and a half and have an IRA or inherited IRA, there's another way to give to charity than simply writing a check. It's called a Qualified Charitable Distribution, or QCD for short. Let me explain how it works so you can see why a QCD can be so powerful. First, some rules. If you are 70 and a half or older, you can make a qualified charitable contribution of up to $100,000 a year from your IRA. If you're married and both of you are over 70 and a half or older, both of you have an IRA, you can each make up to $100,000 qualified charitable contribution from your own IRA. Second, any qualified charitable distribution you make count towards satisfying your required minimum distribution for the year. However, when you make the distribution from your IRA, it must go directly from your IRA to a qualified charity. Or you can receive a check from your IRA custodian and made payable to the charity. Third, this is the odd part, even though you gave to charity, you get no income tax deduction. So, why would I suggest such a strategy where you get no deduction for giving to charity? Because when you make a qualified charitable distribution, the distribution from the IRA is never counted as income when you compute your taxes. Let's see how that helps Albert and Shirley. First, let's suppose Albert and Shirley do what many retirees do. Albert takes his required minimum distribution at the beginning of the year and deposits it into the bank. He's done with his RMD for the year. Now, being charitable people, they donate $5,000 to charity, and the end result is the charity gets $5,000. Everybody understands that, right? But let's look more closely. By virtue of giving to the charity this way, Albert and Shirley's $5,000 charitable contribution will cost them a total of $6,200. Why? Because the $5,000 RMD that went into Albert's checking account at the beginning of the year still has a tax cost. Remember, this couple is in the 24% bracket. 24% times $5,000 equals $1,200. So the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes mean the total cost of the charitable gift is $5,000 plus the $1,200 in tax, or $6,200. Remember, the gift didn't impact their standard deduction, and the RMD behind the gift just added to their income. Ouch! Now let's see what happens if Albert and Shirley use the QCD to give their $5,000 to charity. Instead of requesting a $5,000 distribution from his IRA to go to his bank account, Albert would simply have his IRA custodian transfer the $5,000 RMD directly from his IRA to the charity. That satisfies Albert's yearly RMD because he is over 73. Now, the charity is in the same position as before. They receive $5,000 donation a good day. Albert and Shirley, however, are in a better position. They still give $5,000 to charity even though they receive no deduction for making a contribution. Their IRA distribution is excluded from their tax return. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to give the $5,000 to the charity is $5,000, a $1,200 savings over our previous example, simply by knowing how to use the tax rules to their advantage, and they did it all without ever getting a deduction. But we all know charity starts at home, so it's a natural question to ask, how does retirement tax planning figure in? It's a very good question because the government still wants its share of those tax-deferred assets when you pass away. And like we've seen, how you set things up really matters, which leads us to our final key, number 4. Organize your assets for your family's benefit. Estate planning still matters. Okay, enough about death. Let's talk about long-term care. This is not a long-term care presentation, it's about retirement and taxes. But believe it or not, there are a number of tax breaks associated with long-term care insurance. For example, long-term care premiums may be a deductible medical expense at the federal level and possibly eligible for deductions or credits at the state tax level. And on the other side, if you are receiving long-term care benefits, in many cases those benefits are tax-free. For instance, benefits received from reimbursement-style policies are tax-free. In addition, cash benefit-style policies are tax-free if they don't exceed the higher of your actual long-term care costs or the IRS daily limit, which is currently $410 a day. Choosing how to pay for long-term care costs can have a big impact on your estate and your heirs. In recent years, Non-traditional long-term care policies that blend together some long-term care insurance and life insurance have become popular. Often, the first inclination of the insured here is to tap the policy to pay for a long-term care cost, but that's often a tax mistake. Let's take a look at Florence, a widowed woman who qualifies for long-term care benefits and lives at home with in-home care. Her yearly care costs are $60,000. Florence's Social Security benefits is $20,000 annually, which covers her basic expenses but not long-term care. She also has $400,000 in an IRA and a life insurance policy with a long-term care rider that will pay $500,000 to Florence's children upon her death. Alternately, Florence could use up to $10,000 per month for long-term care costs. Any amounts used for long-term care will reduce the life insurance death benefit. Please note this is just an example and it's not meant to represent any specific policy, but many long-term life insurance hybrid policies work this way. First, suppose Florence is infirm for 5 years and uses her policy to pay for long-term care expenses. That's why she bought it, right? Here, Florence pays little to no income tax during this period because she'll have such large unreimbursed medical expense deductions. The $500,000 policy pays out $300,000, $60,000 a year for 5 years. That means her kids will inherit tax-free life insurance of $200,000, the remainder of the $500,000 policy in value. In addition, her children will receive the $400,000 in her IRA, which will be taxable to them. Now, let's suppose Florence lives for the same 5 years, but uses her IRA money to pay for the long-term care expenses instead. Florence still pays minimal income tax per year because of her high medical expense deduction. And now, the kids will inherit the $500,000 of life insurance completely tax-free, as well as roughly $100,000 of her remaining IRA, which will be taxable. Comparing the scenarios, the ultimate net benefit is unknown because it depends on Florence's children's tax rates. But it's hard to imagine a scenario where paying for her care with $300,000 of taxable money with minimal cost to Florence is not a better option than paying for her care with $300,000 of tax-free money. In the second scenario, we're preserving the tax-free money for heirs and paying for the long-term care with Florence's taxable IRA money. Okay, we're toward the end and you're probably thinking, goodness, how in the world will we ever manage this? It's a good question and let's bring it all together. We started with a clear statement about the problem. Retirees often pay more taxes than expected because of a confusing system that treats various income types differently and contains hidden taxes and penalties. So let's do a quick review of what we learned in the context of the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire. And we also saw that in those pre-retirement years, it's critical to consider your tax-deferred savings and start taking advantage of funding Roth IRA accounts to fill your brackets, something you'd do through your early retirement years in low tax years. We also looked at Social Security and taxes, plus the importance of couples having a benefit strategy that considers their surviving spouse. And we saw Medicare has its own tax-like structure that can push you off the IRMAA cliff. And we saw the importance of signing up for Medicare on time, right in the middle of those early go-go years. That's because starting in the middle, your retirement years, you'll be confronted with required distributions, and we've seen the importance of planning your income needs before then and tax issues involved. And then we saw the importance of setting up your assets and managing them during the later years of retirement, so that you can preserve the most for your heirs and leave them in the most tax flexibility. All those items together lead us to this obvious solution to our original problem. Because your tax exposure will change throughout your retirement, you need a strategy that anticipates how and when you tap assets to cover your personal expenses, understands the range of taxes you will face at various stages, and manages your actions so you pay the lowest tax rate possible. By attending this presentation, you're indicating that you're preparing to leave the accumulation phase, saving for retirement, and moving to the distribution phase when you start spending retirement assets. We've seen the distribution phase is more complicated than working and collecting a paycheck. Managing your tax rate through the 4 stages of retirement is part of the challenge of retirement planning. We've seen the cost of mistakes. Naturally, we want to be efficient with our savings, and there are strategies to reduce your tax burden, but as with many things in life, this takes education and planning and advice. It's a lot to think about. Our tax code is complex and the rules keep changing, but what doesn't change is that you need a plan. And, for spending some time with us today and learning these concepts, I want to offer the opportunity for you to meet with me, whether it's on a phone call, virtually, or at the office to answer any questions you may have about your own situation. We would like to learn more about your specific questions and how we can be of help. You can engage us for a no-obligation follow-up conversation. You can email me at the email address on the screen, give me a call on our toll-free number, or book a follow-up phone, video, or in-office meeting. There'll be a link to do that in our follow-up email, and you can also book it right on the main page on our website, budwealth.com. These 2 resources on this slide will be available to you as a nice referral to what we talked about today in this session. I hope you found the information helpful. I know it was a little technical at times. Hopefully these summary resources can bring it all back to you when the time comes. Thanks again for attending today's presentation. I am grateful for the time that you've spent with me, and I hope you found the information of value. Thanks again. I hope to see you on a future event.